Hello. This checklist deals with capital structure of a corporation. This is a huge issue in taxation. Debt versus equity. Why exactly does it make a difference? Well, in the federal income tax law, traditionally, it's favored debt over equity. How exactly? Code section 163 deals with the deduction for interest paid with respect to various transactions. The Tax Cuts and Jobs Act of 2017 puts a severe limitation on section 163 deductibility. But with respect to deductibility of dividends, there's no general provision in the Internal Revenue Code that deals with dividend distributions. There's a deduction allowed for debt, but not for equity. So many corporations try to classify financing, usually when it's an issue, is when it's not that clear cut as debt versus equity. Now, it's not always the case with respect to the shareholder. The shareholder might prefer to have equity over debt because there's certain preferential gain treatment for dividends. There's various benefits of debt over equity and equity over debt. Again, debt provides interest, which equity generally does not. However, equity provides benefits over debt. With respect to timing, shareholders have more ability to defer tax with respect to dividend receipt an owner would have with respect to receiving interest on corporate bonds. Well, usually, in traditional debt sense, interest is paid on a fixed schedule. However, with respect to equity, it's not true that you'll receive a dividend all the time or on a fixed schedule. Whenever this issue comes up, debt over equity, equity over debt, the IRS may question whether all of the purported interest payments paid by, let's say, a closely held corporation to its shareholders, whether they're actually in fact interest or whether there's some form of disguised distributions. Why does it make a difference? Again, because the corporation can get a tax deduction which avoids the issue that we all know about double taxation at the corporate level. Now, the key is to try to analyze what the financing really is. This takes into account various concepts through case law, regulations, and the Internal Revenue Code. Now, this is more of a factors test. In the law, we have many factors tests. A factors test means that there's no bright line rule or super weighted item that we look at. We have to look at the totality of circumstances. Let's consider preferred stock. Preferred stock has certain attributes that are between debt versus equity. Common stock is the most residual ownership there is. If you were thinking of a continuum and you had debt, or let's say bonds, on the left side, and you had common stock, which is the last with respect to liquidation and the ultimate owners, and we drew a line, preferred stock would fall somewhere in between the line. It could be here, it could be here. It really just depends on the kind of preferred stock. Preferred stock can have different classifications depending on the corporation. Now, generally speaking, preferred stock has priority. It's going to come before common stock. We know that with respect to dividend distributions and liquidation. However, debt or bondholders, they're going to get the first bite at the apple with respect to liquidation before any stockholders, including preferred stockholders. So Code Section 385 of the Internal Revenue Code deals with debt versus equity. And it's not very descriptive. It actually, in Section 385A, allows the IRS, through the Department of Treasury, to issue regulations regarding this area. Congress has provided 5 factors to consider. 5 factors. Those factors include whether there's a written unconditional promise to pay on demand or a specified date, some certain in money, in return for adequate consideration in money or money's worth, and to pay a fixed interest rate, whether there's subordination to or preference over any indebtedness of the corporation, the ratio of debt to equity and corporation, whether there's convertibility in the stock of the corporation, and the relationship between the holdings of the stock and the corporation, the holdings of the interest in question. These 5 questions, depending on the situation, can alter this continuum between debt versus equity. Section 385 specifically states at the beginning that IRS has the right to promulgate regulations with respect to this topic. Congress pretty much just punted on this issue. They had no idea because, again, as I mentioned, this is one of the most difficult issues in all of tax. how do we classify debt? What exactly is debt versus equity? Some of you are thinking, oh, I know exactly what that is. I can just picture it in my mind. We're talking about those crazy situations, especially when you're dealing with smaller corporations, where there's some type of financial investment vehicle that seems like it's in between debt. Maybe it has some flavors, to do with equity, and it also has some flavors with debt because you're in between that line. You're in between that line. So Congress just didn't really understand. So they punted to IRS, and in the late 1980s, the IRS issued some regulations. But pretty much all it did was just make things more confusing. So they got pooled. Since the 1980s, this has been one of the most difficult issues in all of tax law. In 2016, the IRS again issued regulations, but many of the issues were left untouched. Since this issue has come up, it's really been driven by case law. The cases have looked to a bunch of different factors, and I provided you with a list of some different factors as well as what exactly they mean. So the first factor to consider is the form of the obligation and agreement. So in tax law, we have something called substance over form. We have to look at the substance and the form of the transaction. So we're looking at the form of the arrangement of this financial instrument. Does it look more like a debt instrument? Is there an unconditional promise to pay, repay the amount, making it more like debt? Is there specific remedies for default? Because with respect to equity, you might not get your money back. That's the whole idea of common stock. You might not get your money back if your investment doesn't turn out right. Is there a stated reasonable interest rate? Is it too low? Is it too high? Is it contingent on profits? What is it? Is the interest payable in all events? Because remember, a dividend is not required to be paid with respect to common shareholders. However, if you have some type of traditional debt, the interest will have to be paid. That form of the obligation, that can be a huge thing to consider. The debt to equity ratio is the next thing to consider. If a corporation has a very high debt to equity ratio, it's most likely that the instrument would be considered equity. The idea is that if we have a high debt to equity ratio, if it's high, that means there is a large amount of debt in the corporation. The idea here is that we're going to assume that the corporation is trying to maintain economic balance. We're going to assume the corporation is operating to be as profitable as possible, which means that there is a sweet spot with respect to how much debt and how much equity there should be. You don't want to be over leveraged, because if the corporation is not doing well, then you can't pay the interest. But you don't want to give up all ownership, especially those owners that currently own the business. They don't want to give up the ownership. Intent of the parties. What is the intent of the parties with respect to this transaction? Now, this isn't something is extremely important because, again, substance over form, this can be overtaken. Proportionality. If all shareholders make contributions of financing, it's more likely that the debt is equity because shareholders' interests have remained unchanged and the corporation hasn't been leveraged. So you got to look at everything in totality of circumstances. Subordination of debt. Subordination of inside debt over outside general creditors, it's more likely equity because it's taking precedence over that type of debt. So you can have junior debt and senior debt. The extent of participation in management by the holder of the instrument. So the more participation in management, the more it looks like equity. Voting power. Voting power by the holder of the instrument. That makes it more like equity if that's there. Ability of corporation to obtain funds from other sources. This can make it more like equity in the sense that a loan can be taken. Risk involved. The higher the risk, the more like equity it is. Again, we're looking at this continuum. This continuum goes from both sides. From debt over here on the left to equity over here on the right. Provision of fixed interest rate. The more likely there's a fixed interest rate, the more likely it's seen as interest. Contingency and obligation to repay. The more contingent an agreement is, the more equity it's like, because with debt, think of a bond. Think of a traditional bond. It will be a fixed amount that must be repaid. Source of interest payments. Where are the interest payments actually coming from? Are they coming from profits? Because if so, and the agreement is that, okay, well, if we don't have a profitable year, we're not going to pay you interest, that looks more like equity. because that seems more like a dividend to me. You got to really test these things out. Presence or absence of a fixed maturity date. If there's no maturity date, it's possible that the agreement really, truly is that there might not be repayments. You got to consider that. Provision for redemption at option of holder. This can potentially make it more like equity. And timing of advance and organization of corporation. That's something, again, we have to consider in totality of circumstances. So these are just 15 different factors that many cases have considered in different circuits. And again, the key here is that this is one of the most difficult issues in taxation. Understand that corporations get a deduction benefit with respect to debt that can avoid double taxation versus equity they don't. It makes a big difference. But remember, the shareholder might actually like equity. But the key here is the IRS get down to the nitty-gritty, and they're going to look at this in totality of the circumstances. I mentioned earlier the Tax Cuts and Jobs Act of 2017, and starting in year 2018, business interest deduction is limited to the sum of business interest income plus 30% of adjusted taxable income, which is the big limitation, and floor financing interest, which before 2018, this was not the case. There was no 30% of adjusted taxable income limit. And adjusted taxable income, just so you know, actually has been defined to be EBITDA, earnings before interest, tax, depreciation, and amortization, prior to 2022. And after 2022, we use earnings before interest and taxes, which is even more restrictive. Now, this doesn't apply to businesses that are below $25 million, but it's important to understand that this does put a damper on interest. But the rules still apply. These debt equity rules still apply here. But the point is that, again, you see that being able to deduct interest is a bigger item over the fact that you can't deduct the dividends.